The global slowdown and the collapse in commodity prices is triggering bankruptcy concerns, not just in the oil industry, but across the commodities sector. Most recently, Arch Coal, the second largest coal producer in the country, filed for Chapter 11 reorganization. So if you're a shareholder, what are the warning signs that a company might soon go into bankruptcy? Michelle Caruso-Cabrera takes a look.
The history of Wall Street is littered with the charts of commodity companies like this one that have tremendous rallies when commodities are smoking hot and then plummet along with the underlying commodity when things go bad. Arch Coal went from $744 just a few years ago to being virtually worthless. If you were to do an autopsy, a financial autopsy, say, of Arch Coal's bankruptcy, you would find that there were clues for stock investors that maybe they should have gotten out. The key thing with any commodity company right now is you want to look not at how the stock is trading, but how is their debt trading. If you look at Arch Coal, they had a note that was due in 2021. It was a 10-year note, $1 billion worth of debt. At the time they issued it, the yield was 7.25%, already high, already suggesting risk. But it traded at par for a couple of years. Then in January of 2014, the price falls to 78 cents on the dollar, yield rising to 11.77%. 9 months later, the price of the debt falls to 53 cents on the dollar, 20% yield. Now in bankruptcy, it is worth virtually nothing. If you talk to bankruptcy attorneys, they say, listen, there's a big warning sign for commodity companies. If the vast majority of their debt is trading somewhere between 50 and 70 cents on the dollar, that is a problem. And here's why. That suggests the company is distressed. If it goes into bankruptcy, gets restructured, the debt holders get satisfied before the stockholders. What often happens is there's nothing left. What they say to the debt holders is, they say, listen, we can't pay you. So what we're going to do is we're going to make a new company, and we're going to give you equity in that new company. And the guys who had the equity in the old company, they're going to get zero. Debt becomes equity, and equity, the current equity, often becomes zero. If you're invested in smaller exploration production companies or other kinds of commodity companies, you want to take a look at how the debt is trading. For Nightly Business Report, Michelle Caruso-Cabrera.